In this video, I'm going to cover the importance of the signal bar in the New York Open strategy. Let's have a look at this chart. Upon New York Open, we have 4 consecutive bull bars breaking to the upside, and the last bar is very big. That means the breakout strategy for us upon the New York Open. However, is that the case that you can have a successful strategy going up and then make profit? Not necessary. This time, we're going to talk about the signal bar in terms of determining when you pull your trigger and then have a successful trade. Why the signal bar is important? Because it is part of the strategy. Then what is strategy? There are a few components. The first is the setup. Like here, it is the New York Open strategy of breakout. We also have other setups like a wedge breakout, trend line, levels and previous high and low, etc. So these are all setups on the left. Before you pull your trigger, what is the win ratio for the setup? Do you want to trade this setup, etc.? You have to figure out this. Second, what is the entry? Basically, it should be based on the signal bar. If there's a signal bar telling you that you need to trade for this setup, go ahead. Otherwise, if the signal bar is not very good or it doesn't show up, do not trade, even if the setup is very good. So this is the topic of this video. Third, stop. Basically, there are 2 types of stops: initial stop and actual stop. So when the setup is there and then you want to pull your trigger, but the market doesn't necessarily to go your way right away. So you do not put your stop right at the bottom or the top of the pullback. You could get stopped right away. So that's why you need to have an initial stop, a little bit more room for the market to develop. And right after the market goes your way, you put the stop at the top or bottom of the pullback depending on your direction. Fourth, the exit. When you are in a trade, when do you want to exit? 1 time of the risk, 2 times, or in between? Or when you're using the trend lines or pivot levels, previous high and low? This is very complicated, but you have to have a rule or mechanism to take the profit before the trade goes to the other direction. So that's why exit is also very important in a trading strategy. Last, the trade management. A lot of times when you're in a trade, market won't go as you planned exactly. So in that case, sometimes do you want to take your profits earlier or you want to stick around? Do you want to take the loss and then exit the trades if the market doesn't go your way right away? Or you want to stick until maybe later on it hits your stop? Or you want to manually exit to break even? All these things are depending on your trade management rules. You have to base on your study of the previous chart or historical data to decide what you want to do in each of the situation. Let's go back to this chart and take a look at the signal bars and decide whether there's a good opportunity for the trading. After the 4 breaking out bull bars, we have a pullback with 2 consecutive bear bars. And then next is a bull bar, is a doji bar, and the body is small. Do you want to take this as the signal bar and then trade upside right away or not? To me, this is not a very good signal bar. Because normally for a good signal bar, first, it should be a trend bar. Trend bar means the body account over 60% of the whole candlestick. Or if it is not a trend bar, at least I want to see a big tail to the opposite direction. For this example, if we are trading upside, I want to see a candlestick bull bar, but the tail at the bottom is very huge. That confirms the support. So normally, the good signal bars should be having these characteristics. That's why this bar is not a very good signal bar. Let's see what happened next. Followed by 2 consecutive bear bars with body larger than the previous bear bars here. So if your strategy is to wait for the bull bar to finish and then trade at the top of the signal bar, then you won't get triggered. But if your strategy is to use the market order, whenever you see this is a breakout, I want to enter right away, then you can see this is what happened next, and then you will have a potential loss right away. You may say that, what about this bar? this bear bar with a very big tail at the bottom, this means the support. To me, this is not a very good signal bar as well, because this is a bear bar, it's not a bull bar. Another way to look at it is that take a look at the whole range for the upside. It already go down to over 50% of the whole range, so the setup may not hold anymore. Next, there's another bull bar, but the tail at the top is big. That means resistance. So this is not a good signal bar either. So that's why you don't want to trade when you see this bar. Another thing is that even for this small doji bar, this bear bar, and this bull bar, if you put your entry at the top of the candlestick, this bar won't trigger. This bar won't trigger, but this bar will trigger. Then if you trade after this bar finishes, you're in a trade right now. This is what happened next. If you use this bull bar as the signal bar and this bull bar as the signal bar, at least your entry is not triggered. You don't have to do anything. No trade for the day. But if you trigger at the top of this bear bar, you're gonna have a loss because the market goes down too much. You may also notice at the very beginning we are trading the breakout strategy. However, the market reversed. So if we take this as the range, then we can say the market breaks out the range and the retest. Yes, exactly. If that's your strategy, if you use this as the signal bar and then go down, you may have a profit. And then the thing is that it may not trigger your one time of the risk because the market reverses back. So after the market goes down, if you put your stop at the bottom of this signal bar here, then you means you can have a break even because this bull bar will trigger that. And then for the day, you have one trade and then you have no loss at least. There are a few things to notice. First, the breakout strategy comes first, and then it can turn to a break and retest strategy. So you need to be flexible in terms of the strategies here. Second, why the market doesn't go down too much and then give you a successful trade. First, you need to understand that trading is based on the probability. Not all the trades will give you a successful trade, even if the setup looks good. Second, in terms of this break and retest setup here, you can see the market here. By reading the price action, there are bear bar, bull bar, bear bar, bull bar, bear bull, bear bull. That means the market strength is lowered. That's why going to the downside, the strength is reduced, and why you have only a break even rather than a successful trade.